The unbelievable debt load is impossible to escape. It haunts the financial system. It creates a system that is decaying. Just look around, $17 trillion of negative yielding debt, trillions upon trillions printed out of thin air from central bankers and given to friends in high places. Maximum disparity in between the haves and the have-nots. A system that is breaking down. So what's the solution? Well, the central bankers will surely project themselves at the right time, claiming reluctance but acceptance to begin a torrent of printing and purchase assets of all kinds. You've been warned. You came here for the truth, so let me unveil that for you. Today we are going to look at a few topics. Number one, I want to talk about the next financial bubble. Very important. We are also going to look into what the Federal Reserve has done. Is this the beginning of QE4 or is this just more status quo, business as usual? Then we're going to get into what's happening with negative yielding debt. It has now expanded to $17 trillion globally. I've got a big video today. Let's get into it right away. The Big Short's Michael Burry says he has found the next market bubble. It's something that I have talked about over and over and over again. We are talking about passive investments, that is the ETFs, watching as all of the financial assets disappear, all of these active funds going away, hedge funds closing up shop, and you see trillions of dollars moving into ETFs. Passive investments are inflating stock and bond prices in a similar way that collateralized debt obligations did for subprime mortgages more than 10 years ago, according to Michael Burry. Like most bubbles, the longer it goes on, the worse the crash will be. This is something that I have talked about so many times before. They can actually persist. They can push this, they can kick it down the road. But the longer that it goes for, the worse it's going to get. That's what I have said numerous times. Of course, you know that if you've been here on the channel. He had a really good analogy here. The theater keeps getting more crowded, but the exit door is the same, and it always was. All this gets worse as you get into even less liquid equity and bond markets globally. Watch as all of these investments become squeezed down into fewer and fewer. You get the FANG stocks, you have the tech stocks, okay? Nobody is really investing in what they should be today simply because they are afraid. They're looking at what they know. They're simply saying that they're not going to go anywhere. Apple's still going to be there selling phones. Amazon, everybody buys everything on it. Therefore, if I just put my money into these companies, I will do well and I won't have to worry about my money and so on. This is not the way it should be, of course, but this is where the money is flowing into. Fewer and fewer stocks. And of course, we have the problem with these asset bubbles that are expanding to a rate that nobody has ever seen before. In the next financial crisis, we don't necessarily know what's going to happen with all of these passive funds because they were infinitesimal compared to where they are today. It has really grown. This is Jack Bogle himself. If historical trends continue, a handful of giant institutional investors will one day hold voting control of virtually every large US corporation. Public policy cannot ignore this growing dominance and consider its impact on the financial markets, corporate governance, and regulation. These will be major issues in the coming era. Can you believe it? This is the man who basically created index funds saying what we have done here is going to create a problem in the future. Nobody really cares. They're simply just putting their money in. I'm going to dollar cost average. I'm going to buy the dip and I'm going to be fine. This right here is a warning and I hope that you are paying attention. Topic number 2 is the Federal Reserve. This is the 10 and the 2 year. You watched how this inverted recently. I've been talking about it. You've been seeing it all over the news. But of course, we saw that the yield curve inversion took a turn. And this isn't the only time this may happen. It may happen 5 times, 10 times before we actually get this to persist. But this right here, the flattening of the yield curve, started to spark some concerns about why this was the case. Why, in fact, was there a yield curve inversion and then a flattening of that yield curve in a time where there is exactly the same conditions? Nothing has changed. So let's look at this. At its absolute peak, the Federal Reserve held approximately $4.5 trillion in assets. Among that, they had the mortgage-backed securities, they had the treasuries as well. At one point here, they decided that they would not buy any more treasuries. They would try to keep it at exactly the same level, and for the most part, they did that, held onto it for a few years. Then they started their quantitative tightening policy. It freaked out the markets, and you know where we have been ever since. The one thing that did not happen over the last several years was the Federal Reserve actually increasing the amount of treasuries that they have had. Here you can see that that has changed over the past couple weeks. They actually purchased more. They increased their purchase of treasuries, and this right here marks a big change in between now and over the past few years. As I have said in the introduction, doesn't necessarily mean that we are now in QE4, but if this trend continues, this is something to pay close attention to. Sure, there can be little variances here and there. I wouldn't necessarily say anything until it's a trend, so I'm going to keep a very close eye on this, and I will warn you of any major events. Within this article here, there was this comment that I found very interesting. The Fed has already announced that they will be reinvesting the principal repayments from their MBS holdings and treasuries, so this is a non-event and not news to the market. The Fed is swapping their holdings of GSE mortgage bonds for treasuries, which are more effective for conducting monetary policy operations. That's what a lot of people would say. This is what the news will say. And of course, there's more to it than that. Check this out. Since March 2019, when the Fed rolled out its plan, the Fed has ended its treasury runoff sooner than they had communicated, cut rates as they said they would not, and is buying mid and long duration bonds while aggressively rolling off, selling off notes and bills. Again, opposite to what they previously communicated. I think this is noteworthy. Mr. Hamilton makes a very good point, and that's why I wanted to bring it to you. Here is the information directly from the Federal Reserve's own website, okay? I want to show you the data as it comes from the horse's mouth, because then you could see it for yourself as it all unfolds. Beginning in October of 2019, principal payments received from agency debt and agency mortgage-backed securities will be reinvested in treasury securities subject to a maximum amount of $20 billion per month. Any principal payments in excess of that maximum will continue to be reinvested in agency MBS. There's more details in here, but it looks like they are shifting more into the treasuries, getting out of the mortgage-backed securities. But is this really what's going to happen? Are they saying one thing and doing something on the opposite side? I'm going to give you those details in the coming weeks, the coming months, so stay tuned. This interview with Alan Greenspan connects the second part of this video to the third part, so I wanted to show you what he's talking about. It will not be long before the spread of negative interest rates reaches the US, according to former Fed Chair Alan Greenspan. You're seeing it pretty much throughout the world. It's only a matter of time before it's more in the United States. This is very important, and you could see what central banks are doing. They're all going in the same direction. Below is a list of recent emerging market central bank monetary policy changes. They're all cutting. All of these central banks around the world are going into the next phase of quantitative easing. They're either printing money or they're reducing interest rates. We are watching this happening after 10 years of easy monetary policies. The world has never seen a big bubble like we are encountering today. This will go beyond anything the history books have. We are going to start rewriting everything after this event unfolding. There is no doubt about it. Take a look here. You're seeing everything from Botswana, Jamaica, and Egypt, and Indonesia, and I can scroll and scroll and scroll, and you will see how many countries today are doing the same thing. They are cutting rates, and it doesn't matter where you look around the world. It seems to be everywhere. My goodness, this is just going on and on and on. Now take a look at this. You can see this interactive chart, and it's the emerging market central bank cut rates by most in a decade. Looking at this line right here, minus 14 at the very bottom, it just shows you a list of all the different countries that are involved here. It's unbelievable to see all of these countries acting together. It isn't the United States doing one thing and you're seeing the ECB doing another. No, they're all doing the same thing. The unstoppable surge in negative yields reaches $17 trillion. Just recently, this wasn't even in the double digits, and now suddenly it's already heading towards 20 trillion very rapidly. The global stock of negative yielding debt is now in the excess of $17 trillion as rising market volatility lends extra force to this year's unprecedented bond rally. 30% of all investment-grade securities now bear sub-zero yields, meaning that investors who acquire the debt and hold it to maturity are guaranteed to make a loss. It's unbelievable, but that's the state we are in today. This just shows you how fast this has come up in this period of time. It has simply gone into astronomical territory. It's going very high, very fast, and the world doesn't know how to handle it. This is another interactive chart that you can simply put your mouse over, get a breakdown, looking at, for example, Asia, $7.3 trillion. This is all from Japan. If you look at Europe, we see the breakdown in France, in Germany, and so on, just showing you all of this ridiculous negative yielding debt and how that is all comprised. Take a look at how this really comes to be. It's unbelievable. At the bottom there, it's just trying to give you an explanation of how to get a negative yield. Just imagine you have to put all of the risk out there, all of your hard-earned dollars, your savings, and you get a negative return. It's unbelievable, but that's what we have. It's really, truly mind-boggling. To see the results of lower negative rate environments, look no further than the Eurozone and Japan. They account for 87% of the negative rates worldwide. Europe is essentially in recession with negative GDP in Italy and Germany and elsewhere. Its banking systems are a mess thanks to negative rates. European banks are trading at the lowest levels in more than 30 years. Japan not doing much better. And then it breaks down the fact that if we see the exact same thing happening in the US, UK, Canada, Australia, New Zealand, we are going to be in a world of hurt. Look at this right here. Europe's bank stocks are at the lowest levels in more than 30 years. It never recovered from the financial crisis. In fact, it is much, much worse. Many years of ultra low rates have weighed on Japanese bank shares. Look at when you see this in the news talking about Japan being this so-called model of success for low rates and for money printing. Just look at this chart and you tell me how that is the case. It is a complete fraud, and every time I see this comment, which happens regularly, it is truly an embarrassment for that person. Two more things I want to touch on very quickly. New York Fed President John Williams says low inflation is the problem of this era. This leads me to believe that we will see massive quantitative easing in the future. There is going to be no other way around it. Imagine what they printed last time. It's going to be insane this time around. And last but not least, longest losing streak for global PMI. Can you believe this right now? Worse than 2008, worse than 2000, worse than all the events in between now and then. This is a real indicator, and you are seeing it happening right before your very eyes. That's all for this video. If you found it informative, hit that thumbs up button. Remember, you make a unicorn cry when you leave the video before you click one button. If you want to learn how to make money, how to build a business, how to actually create passive income, I made this course, the Amazon GPS, to tell you how to sell on Amazon the right way, the proper way, the way in which you work once and you make money for a long period of time. Minimum investment to get started, the way I teach. My course is free to actually get all the information that you need to download. Check it out, the AmazonGPS.com. If you want the financial education that was left out of the school system to keep you in the dark, I broke it all down in these two books. You can check that out at the link in the description. If you want the audiobook, that's available at themoneygps.com. Hold on, hang on. Have you seen this video? We are talking about an economic crisis that the world is simply unprepared for. If you haven't watched it already, click on it and I will see you there.